All right. Welcome back to Principles of Counting One. Still your host, Dr. B. Happy to have you with us as we are already, and if you can believe it or not, honestly, I'm having trouble keeping up with the time because it's going by so quickly. We are already in week 10 of this course, which means we only have a few weeks left, if you can believe that, right? We go up all the way up to week 16, which is going to end actually on April 2026 is going to be the last day of this course, which is about a month and a week, roughly, right? So we're looking at about 5 weeks left of the course, and I promise you, it goes by very quickly. So we're already in week 10. Last week we had a discussion board, and we also had a quiz on on that chapter. I have not yet graded the discussion board, but I will tomorrow. I'll be grading the discussion board tomorrow. So don't worry if you don't see a grade for your discussion board yet, because I haven't graded it yet. I'm gonna take care of the grading for the discussion board tomorrow. Okay. Uh, for this week, what we got going on is we're going to talk about property, plant, and equipment, which are also known as fixed assets. You'll have a hypothesis for this week, hypothesis video. Just as before, you'll open up the video, you will watch it, highlight, and make your hypothesis. I see Maria Jordan. Maria and Jordan are already in there, so thank you so much for working ahead. Always appreciate that. So just as before with the hypothesis, and then you'll have your Chapter 10 quiz related to property, plant, and equipment. There will be a couple of depreciation questions in there, which is why I want to make sure that we cover that in depth. Okay, so let's jump into our conversation today on property, plant, and equipment. Now, you'll see that I refer to it as property, plant, and equipment. The property, plant, and equipment are also known as what we call fixed assets. Property, plant, and equipment are also called fixed assets, and they're found on your balance sheet, right? These are what we call long-term assets or fixed assets. Property, plant, and equipment on the balance sheet as fixed assets or long-term assets. The idea here is that in business, we use our fixed assets, property, plant, and equipment, to help the business to generate revenue, right? That's the whole idea. That's what assets for the business do. They help the business to generate revenue, generate sales. And so we're going to talk in detail a lot about our property, plant, and equipment, also known as fixed assets. I'm going to show you how they're computed. The value of the property, plant, and equipment are computed. I'm going to explain to you what depreciation is, how it works, why we compute it, and I'll give you some real life examples. And of course, we'll finish up with a couple of ratios and appendices. So first, let's talk about property, plant, and equipment. Property, plant, and equipment are tangible assets that the company uses for more than 1 year. Okay? These are also known as what we call fixed assets. Property, plant, and equipment. The majority of fixed assets are used to help to generate the company revenue. So we use our building, we use our machinery, we use our environment to help the company to generate revenue. Yeah. So, for example, in the restaurant business, those of you who have ever worked in a restaurant or been to a restaurant, fixed assets at the restaurant would include the restaurant itself, okay, the building. It would include the tables and chairs. Yeah, that's furniture. That's also a fixed asset. It would include the kitchen equipment in the back. Okay, all of those things are called fixed assets, property, plant, and equipment. They're tangible in nature. We use them in the day-to-day operations of the business. They help to generate revenue. That's what this term, expected to benefit future periods. The fixed assets help the company to generate revenue or sales. And we call these property, plant, and equipment. So that's the definition of what we call plant assets or fixed assets. Now, here's the thing that you need to know about fixed assets. As the asset gets older, it starts to lose its usefulness, right? For example, the building, it starts to, deteriorate over time. This is true, right? If you think about your car, or if you have a vehicle, what happens to it over time? Who can tell me? What happens to a vehicle over time? You're driving it and you're using it a lot. What happens to it? Who can tell me? Don't all talk at once now. I know this is a tough question. Who can tell me what happens to a vehicle over time when you use it?
The gas,
And what?
the gas.
Yeah, it uses fuel, of course. That's how it operates. But what happens to it when it gets older?
Does the value depreciate?
Value depreciates, that's right. And it starts to, have some issues, right? It starts to act a little funny. Things start to break on it. You know, you got to replace the tires. You got to replace certain parts. They break. This is normal. It's a piece of machinery. Machinery breaks over time. Even if you take care of it, you change the oil, you take care of the tires, you fill it with gas, all these great things. Over time, it breaks down. That's normal. You know what I mean? Because it's machinery. Machinery breaks down as it gets older. It loses its usefulness, right? Because when it breaks down, it's no longer as useful as it used to be when it was new. You see? So when things use its loose, when fixed assets lose their usefulness, we call it depreciating in value. It's losing its value, right? So we need to account for that loss in value. And we do that through what we call depreciation. So this graph that you see in front of you represents that loss in value. The first thing we do when we acquire an asset is we record its acquisition cost. Now, the thing with acquisition cost is it's not just the purchase price of the vehicle or the asset. It's also the cost of delivery, the cost of uh, installation, the cost of getting it to you. Yeah, we call those acquisition costs. Acquisition costs are not just the purchase price. It's the purchase price plus insurance, plus installation, plus whatever, right? To get it up and running. All those together equal what we call the acquisition cost. And then over time, it loses its usefulness. So we record the acquisition cost, but we also have to figure out how long is it expected to last. We call that useful life. Its useful life is determined by figuring out how long it's supposed to last for. In reality, the way it works is that the government tells us how long things last for. For example, a vehicle, according to the government, might last about 7 years. Okay, so its useful life would be 7 years. Although we know we're going to use it longer than that, right? And then At the end of the useful life of the asset, we figure out how much is it worth. It's what we call salvage value. It's reached the end of its useful life. Whatever it's worth is called salvage value. It's what I can get if I scrap it or salvage it. Okay. So those are really the three aspects that you need to remember as we talk about depreciation. So, as I mentioned, one of the first things we do is we calculate the cost of acquisition. And the acquisition cost is the purchase price plus the other costs, such as installation, assembly, whatever it takes to get it up and running. Okay, let's say we just purchased a piece of machinery that helps us in our business of producing products. Okay, so this piece of machinery, I purchased it for $10,000. That was the purchase price, but that's not all that I paid for it, right? I also had to have it delivered. So delivery, shipping. Plus, I'm not going to put that together. Somebody else is going to assemble it, so I'm going to pay for assembly. Plus, installation. Somebody's got to test it, make sure it's up and running. Yep. So all of those costs together equal the total acquisition cost. You see. So now that we figured out total acquisition cost, I'm going to show you an example from machinery and equipment in this nice graphic. Okay. So machinery and equipment, it's the purchase price plus the taxes, plus the transportation, plus the insurance while it's in transit, plus installation, assembly, and testing. All right. So that's machinery. But what about a building? Remember, it's property, plant, and equipment. What about the building? I'm so glad you asked. So there's two ways to get a building, right? You either purchase an existing building or you're going to build one yourself, right? So there's the cost of either purchasing it or the cost of building it. But that's not the only cost, right? There's titling fees, attorney's fees, taxes, brokerage fees, etc. All of these individual costs together, we add them all up, and that equals the cost of the building. Okay. Just like machinery, vehicles, etc., buildings also depreciate over time. Why, you might ask? Well, what happens to a building over time if you don't do anything to it? It breaks down, right? Just like your house. Let's say you own your house, okay? And what happens when you got to replace the water heater? Oh, I just replaced mine, I don't know, a couple months ago. Ooh, that one hurt, okay? It was expensive. What happens when the house gets older and other things go wrong, right? Your water heater goes down, your appliances break. Okay? Why? Because it's natural. That's what happens when things get old. They start to wear down. You know, you use it a lot, it's gonna break eventually. you know. So the same concept applies in any other building. So think about a business's building, a manufacturing facility, for example, or a warehouse. Things break down over time. Yeah. So um, therefore, they use their usefulness, and that's why we call it depreciating. So buildings and equipment, those depreciate. The only thing that does not depreciate ever is land, the actual dirt. Okay, that does not depreciate. And I'll explain why here in a second. So the cost of the building includes all of these things together. Now let's talk about land and land improvements. The land itself never depreciates. The dirt never depreciates. Why? Because land is infinite. Land is infinite. It means never ending. Yeah? I can keep digging and I can dig all the way down, right? The land will always be there, we hope. The land will always be there. Therefore, the land does not depreciate. The building the land sits on does, but the land itself does not. You might want to think about this here for a second. If you live in DC, okay, you live in DC and you're wondering to yourself, man, why is this little house cost over $1 million? Right? I often wonder that myself. I'm like, why does this little house cost $1 million? It's not necessarily the house itself that's the value. It's the land that the house is sitting on. That's where the value is. You see? So now when you think to yourself, let's say you're on the market to buy a house, and you're trying to understand the value, it's not necessarily the value of the house, it's the value that the land, it's the value of the land that the house is sitting on. That's what you need to understand. Okay. So land. We improve land, right? We all do, hopefully. For a business, improving the land means putting in a parking lot, driveways, fences, walkways, lighting, sprinkler system, etc. It also includes things like, landscaping. Yeah. The improvements that we make to the land, those do depreciate. But why? The parking lot cracks. Okay? The driveway eventually falls apart because of the roots underneath it. The fence is going to fall down eventually. Walkways develop cracks. The lighting systems eventually break. Okay? Those things, yeah, those depreciate. But the land itself does not. Okay, let's talk about the acquisition of land. You're looking to buy a piece of land. There's nothing on it, no building, no nothing. How much does the land cost? Remember, it's not just the purchase price. It's the purchase price plus insurance premiums for the title, property taxes, surveying fees, legal fees, real estate commissions. You add all these things together, and that equals the total acquisition cost for the land. But remember, the land itself, the dirt, never depreciates because Earth is infinite. It's unlimited. You see, the dirt is unlimited. In theory. I know we're not going to go down that road today, but just pretend that the Earth will always be here. Okay? So we talked about equipment, we talked about buildings, we talked about the land. Now let's walk through an example. Here we have an example. Our company, CarMax, those of you who've ever heard of CarMax, our company, CarMax, is looking to acquire a building and some land. Okay? Add a bunch of zeros behind it, and that's probably the actual numbers. But here we go. CarMax is looking to make what we call a lump sum purchase. A lump sum purchase means we're going to pay the whole amount up front rather than over time. That's what lump sum means. And we're going to do it based off of the relative market values, what it's worth at the time. The company is looking to pay $90,000 in cash to acquire some land and a building. The land at the time is $40,000. And the building at the time is $60,000. But I could already hear you, Dr. B, that's not 90. They paid 90. If you add 60 plus 40, that's 100. So where'd the difference come into play, you might be asking? I want you to take a look at what we call the apportioned costs. The apportioned cost is because we're paying in a lump sum, we apportion based off of their appraised values. Okay. In this example, the appraised value for the building the percentage of the value comes in at 60%. And the land comes in at 40%. So, if I take the appraised value 60,000 over the 100,000, which is what we would have paid, that gets us to the 60%. Since I'm paying $90,000 in a lump sum, the apportioned cost was going to be $54,000. How we got there? We took the $90,000 lump sum times the 60%. You see? For the land, we took that $90,000 times the 40% apportioned rate. That gets us 36,000. Add 54 plus the 36, that gets us to the 90. So this is an example of lump sum purchase. Not all that common. Why do businesses do it, you might ask? You can see we got a 10% discount, right? Because we paid in a lump sum rather than over time. Okay, now for the important part of the lesson, the depreciation. As I had mentioned, there's a couple of methods for depreciation. One of them we've talked about before already, very briefly, in a previous week. And that's called the straight line method. Okay? So we have three primary methods of depreciating our fixed assets. First is called straight line. The second is called units of production. And the third is called double declining balance. There are other methods out there, but these are the three primary ones and the ones that are recognized by generally accepted accounting principles and the IRS. So first, as I had mentioned, the concept of depreciation. It's the process that we use to recognize the decrease in the usefulness of the asset over time. Okay, so that's what the interpretation is, to keep things simple. We take our acquisition cost, remember that's the purchase price plus all those extra things, into consideration. We also take into consideration this concept called salvage value, which is what it would be worth at the end of its useful life, and the useful life itself, the time expected that we're going to use this asset. Okay? The concept of depreciation is that we are expensing out the loss of the useful life over time. Okay? And then we do that through this concept called depreciation expense. It's an expense account that goes on your income statement. Okay, at the end of each year, we do it as an adjusting entry. And the other account, the account that gets credited, is called a contra asset account, and it's called accumulated depreciation. Accumulated depreciation is a contra asset account, meaning it holds a negative balance on the balance sheet as an asset. Okay, you're like, oh, Dr. B, that's weird because I know that asset accounts on the balance sheet have a debit balance normally. You're right, they do. But a contra account means it contradicts that respective asset account, meaning it holds a credit balance. I'm going to show you what it looks like, but just keep that in mind. Okay, as I mentioned, how do we calculate depreciation? We got to consider three things: the cost, the acquisition cost, salvage value, what's it worth at the end of its useful life. We call this scrap value, also known as residual value. And the third thing is the useful life. How long is it expected to last? Okay, useful life. How long is it going to be in service for? There are the three methods of depreciation: straight line, units of production, and double declining balance. So I'm going to walk through examples of each. And the way we're going to do that is through a general example. Okay. Shoe manufacturer, Reebok and Adidas. Okay. Reebok and Adidas, or Adidas, these two companies manufacture shoes. Okay. And these shoes, they're sportwear. Yeah. Here is some information on a piece of machinery that the company, one of the companies, is looking to acquire. The machinery will cost the company $10,000. It has a salvage value of $1,000, meaning at the end of its useful life, it'll still be worth $1,000. This means that we would have a depreciable cost of $9,000. Why not 10, you might be wondering. The reason why not 10 is because since it'll still be worth something at the end of its useful life, whatever that value is, we don't depreciate that part. Make sense? Salvage value, because at the end of its useful life, I can just sell it for $1,000. It's still worth $1,000 at the end of its useful life. That's what salvage value means. So we take the cost minus salvage value to equal the depreciable cost. And for this piece of machinery, we expect it to last for 5 years. And we can create 36,000 pairs of shoes with this piece of machinery. Okay, good information. Now try to remember this information. First, let's work through the straight line depreciation method. Straight line depreciation equation is very simple. We take the cost, $10,000 in this example, minus the salvage value of $1,000. That gets us $9,000, right? The $9,000 is our depreciable cost. So 9,000 divided by 5 years. Useful life. So cost minus salvage value divided by useful life. The other way to write the equation is depreciable value divided by useful life. So in this example, cost minus salvage value is 9,000. divided by useful life of 5 years. That is $1,800 per year. So for every year, for a total of 5 years, I'm going to record this exact adjusting journal entry. Okay, at the end of each year. So end of this year, debit depreciation expense, $1,800, and credit accumulated depreciation for machinery, $1,800. As I had mentioned, depreciation expense, that's that's an income statement item. It's because it's an expense. And the accumulated depreciation is a contra asset account that normally holds a credit balance, and that's on the balance sheet. So what does it look like on the balance sheet? Right. On the left side, we see the income statement. Same amount every year for the 5 years. On the other side, we see the balance sheet. We see when we purchased it, $10,000. In 2021, it's worth $8,200. 2022, worth $6,400. 4,600, 2,800, and then we get down to 1,000. Remember, at the end of its useful life, it's worth 1,000. So over those 5 years, I fully depreciated the asset. The way it looks on the balance sheet is that we have machinery, $10,000. It'll always show that $10,000. But just below that line item account on the balance sheet, you're going to see another line item that says accumulated depreciation, and it's going to show a negative number, right? And the reason for this is because we never reduce the value directly from the asset on the balance sheet. Never want to do that. Why? Because you want to maintain the integrity of the cost of acquiring the asset on the balance sheet. That's why we use accumulated depreciation and not just deducting it directly from the machinery account, you see? Okay. Everyone understands this concept so far? Are we doing okay so far? Yes, no, maybe? You all good? We're okay so far. All right. Just making sure. This is what it looks like over time. So remember, useful life is 5 years. We acquired it in 2020. It reaches the end of its useful life in 2025. So you can see that each year it depreciates by $1,800 until it reaches 2025, 5 years, at which point the book value is 1,000. You'll know that you've done it correctly when the salvage value equals the book value. You see? Okay, so that's straight line depreciation. Now I want to get into what we call units of production. And yes, Marlon, I see your hand. I'm sorry, Marlon, I can't hear you. Can you just make sure your mic is set up there? Oh, I think I hear you now. Marlon, want to give it another shot?
Can you hear me now?
I can hear you now. Great.
So when you purchase equipment, you don't record the depreciation until the following year. That's when it starts.
Correct. Well, it depends. It depends on when you purchase it. So, for example, we call these. I'm glad you brought this up because I am going to show you this here shortly. But let's say you bought this piece of machinery in December. Okay, let's say you bought it December 1. in 2020, you would need to account for that 1 month of depreciation in 2020. Okay. And the way you would do that is you would just divide by 12, right? In order to figure out what the depreciation is for that month. So you would take, in this example, 1800 divided by 12, and that's what it would be monthly. So to answer your question, Marlon, it depends on when the piece of machinery went into service. If it went into service in December of 2020, then I would need to account for that 1 month in December. Does that make sense?
Yes, it does. Thank you.
Cool. Awesome. Thank you so much. And I'm going to show you what that looks like in the presentation. Great. Good question. Okay, so that's straight line depreciation. Now let's talk about units of production. We use the units of production depreciation method to account for depreciation based on the machinery's use, based on its actual usage. Okay. Now, why would you use this, for example? Let's say we purchased a piece of machinery that cost $10,000 and we're manufacturing sneakers with it. Okay. I need to depreciate the value of that piece of machinery based off of the number of sneakers I'm producing each year. Because in my business, it's not always the same each year. Okay, so I depreciate based off of usage. That's what units of production depreciation method is. So it's a two-step process. The first step, and we do this every year, the first step is we got to figure out the depreciation cost per unit. And the way we do that is we take the total cost of the machinery, in this case 10,000, minus the salvage value 1,000, total depreciable cost of 9,000, divided by the total units of production, the number of units I expect to produce and sell. In our earlier example, it's 36,000 units. I then take that and I put it into step 2. Step 2 is we got to figure out what's the depreciation expense for the year. Okay? We take the depreciation per unit, in this case 25 cents, and we multiply that by the number of units produced during the year. Okay? Now remember, it's not going to be the same every year. It's usually not. If I'm producing 36,000 pairs of shoes over 5 years, there's a good chance it's not going to be the same every year. So I'll show you what that looks like. So here we have our example. We're producing 36,000 shoes, as I had mentioned. The depreciable cost is $9,000 divided by 36,000 pairs of shoes. That gets us 25 cents per pair, per unit. Yep. I take that 25 cents depreciation per unit and I multiply that by the number of units produced during the period. During the first year of operation, 2021, I produced 7,000 pairs of shoes. So I take 7,000 times 25 cents per pair. That gets me $1,750 depreciation expense for the first year. And now you might ask, well, Dr. B, what about the other 4 years? Let me show you what it looks like. Remember, it's based off of the units of production, the number of units produced during that year. So I produced 7,000 in the first year. 7,000 times 25 cents is $1,750. Right. The second year, 2022, I produced 8,000 pairs of shoes times the 25 cents is 2,000. 9,000 in 2023, that's 2,250. 7,000 in 2024, that's 1150. I'm sorry, 1,750. 5,000 pairs in 2025, it's 1,250. You see, so it's based off of the number of pairs of shoes being produced each year at times the depreciation per unit. Now you see at the end of year 5, when I add up all of my depreciation expense for those 5 years, it should equal 9,000, right? Remember, 9,000 is the depreciable cost. It's the 10,000 cost minus the 1,000 salvage value. Okay? Your book value at the end of year 5 should equal $1,000. That's the salvage value. That's how you know it's correct. Okay, so that's units of production. Everyone understands units of production? Hopefully. That's probably the most complex one. You good? Okay. Just making sure. Now here we have the double declining balance method. Just as the name implies, we're going to depreciate the value of our asset times 2. Double declining. That's the idea. Now you might be wondering, Dr. B, why would a business want to use double declining balance method? Right? That's a good question to ask. And I'm going to give you a very straightforward, honest answer. This is the best tax advantage for a business. Why? Because businesses write off depreciation expense in the taxes. That's the real reason why people would select to do double declining balance. Yep. This is also known as the accelerated depreciation method. We decline by 2, multiply it by 2. Yep. So here's how it works. There's 3 steps. The first is we got to compute the asset's straight line depreciation rate. Just like we did in straight line method, we got to figure out the rate. Okay? So we compute the straight line. What is it per year? Step 1, we take 100% divided by the useful life of the asset. In this case, 5 years. 100% divided by 5 is 20%. Yep, makes sense. So we got 20% per year. That's what it would be for straight line. Make sense? The second step is we're going to double the straight line rate. How do you do that? You take your 20% and multiply by 2. 20% times 2 is 40%. Right? So now that we got our percentage, we got to figure out our depreciation expense. And we compute the depreciation expense by multiplying the 40% rate by the asset's beginning period book value, also known as the cost. Yeah. So 40% times the cost, 10,000, equals $4,000 of depreciation expense in year 1. And we follow this same process for every year. I'm going to show you what this schedule looks like. So we take the depreciation rate of 40% and we multiply that by the beginning book value. Now here's how this part works. The cost is 10,000, as you know. I multiply that cost by the 40% to get $4,000 depreciation expense for the first year. In order to find the next accounting period's book value, I take the initial book value, 10,000, minus the 4,000 that I already depreciated. That gets me a book value of 6,000. I then take that 6,000 times the 40% to get depreciation expense for year 2 of 2,400. And then, as you can tell, I'm going to subtract that 2,400 from the 6,000 in order to get a new book value of 3,600. 3,600 times the 40%, book value of 1440 in the third year. I take the 3,600 minus the 1440 to get a new book value of 2,160. 2,160 times the 40% equals 864 for the fourth year. And then I follow the same process for the fifth year, you see? You'll notice, of course, at the end of year 5, my depreciation expense is 9,000. My book value is 1,000. Remember the salvage value. So you see, the reason why we call it double declining balance is I'm taking the majority of my depreciation expense in those first few years. Again, the reason why businesses do this is because of taxes. If I acquire an asset that costs a lot of money up front, and I want to make sure that, hey, I want the biggest tax advantage possible, I'll probably select double declining balance. Yep. So here we have a comparison by method. Most businesses choose straight line. Why? Because it's the easiest. It's the most predictable. Yep, that's the real reason. 85% of companies usually choose straight line. Units of production, 5%, double declining balance, 6%, other ones, 4%. Yeah, it's pretty average. But you'll notice, as you compare the three methods, double declining balance is going to give you the best tax advantage because you're taking that large amount up front. Straight line is nice and even. Units of production based off the numbers of units you're producing. So it's kind of all over the place. But that's how you compare the three. Yeah. I was mentioning, how do you know how long something's supposed to last? And I had said, the government tells you how long it's supposed to last. And they do this through a system called the Maker's Report. Modified Accelerated Cost Recovery System. Sounds cute, right? If you go to the IRS's website and search for MACRS, you'll come up with this crazy cost schedule, okay? And it's effective. It's really good at telling us how long things are supposed to last for tax reasons. Now, in business that these assets, they're going to last longer than what the IRS says. Okay? You can still use it, the asset. You don't have to sell it at the end of the year 5. The machinery is still going to work at the end of year 5. It's still going to work. You can keep it on your books. Just keep using it. Okay? But of course, you won't be able to depreciate it any further because it'll be considered fully depreciated at the end of its useful life. Okay, this is what Marlon was talking about earlier. What happens if we purchase a piece of machinery or an asset halfway through the year or a quarter way through the year or whatever? We need to account for what we call partial years. And I'm going to show you what that looks like now. So using our same example, let's say, Marlon, we purchased that piece of machinery in October 1, okay, of 2020. I got to account for October, November, and December, 3 months, in 2020. So how do I do that? I bought it October 1, 2020, put it into use. I got to account for those 3 months. And then the rest of it will be the same. So simple. We take the cost minus the salvage value, which is the depreciable cost of 9,000, divided by the 5 years. Okay, we got that part already. That's 1,800. We then multiply that by 3 out of 12 months. Why 3 out of 12? Because there's the 3 out of 12 months that I got to account for in 2020. That gets me $450 for those 3 months. Make sense? But that's how it works. Yeah. Because in normal operations of business, we purchase fixed assets throughout the year, not just January 1, you know. Okay, sometimes there'll be changes made to the assets. Okay. Um, we estimated it'll last 5 years. Oh, maybe it'll last 6. Maybe it'll last 4. Okay, what happens? We need to change our estimates in depreciation expense. Right? It happens. You purchased that piece of machinery. They said it was going to last 5 years. It only lasted 4. Okay, what do? We got to make an adjustment. So remember, depreciation is an estimate. It's not an exact science. It's close, real close, but it's an estimate. We use it to predict useful life and predict salvage value. Okay, so what happens when one of these things change? Here we have an example. Let's say that piece of machinery we've been using, the one we bought for $10,000, we made it to year 3. At year 3, it's worth $6,400. Okay, so we realized in year 3, hey, you know what? This thing's not going to last 5 years. There's no way. It's only going to last us 4. So what do? We have to revise the useful life in the formula. So we take the remaining book value, 6,400 in this example, minus revised salvage value, because we also realized that changed as well, down to $400, divided by the revised useful life, 4 years. This changes our calculation from what it was before, 1,800 to 1,500 per year. So those kind of things happen. You just have to adjust. You might wonder, why else, Dr. B, might something like this happen? And I think we're going to talk about this here shortly. Sometimes a useful life, we have to do an overhaul on it, and it changes its useful life. For example, let's say it's the machinery is a vehicle, and something happened to the transmission. So you replace the transmission in the vehicle. What that does is it extends the useful life. And we call that an extraordinary repair. We'll talk about that. Also known as, it could be considered a capital expenditure. So I'm going to talk about a couple things. Normal expenses. Normal expenses are revenue expenditures. These are just normal expenses. They're on your income statement. Example of normal expenses would be maintenance. You got to change the oil. That's not going to do anything to useful life, but you have to change the oil to make sure it keeps running. That's just general maintenance. These do not change the useful life. Change the oil in your car, it doesn't change its useful life. It's just maintenance. You have to do it to keep it operating. We record it as an expense during the period, and it's reported on the income statement as an expense. That's different than a capital expenditure. A capital expenditure, that's on your balance sheet, okay? They provide a benefit to the asset. Example, replacing a transmission in the car. That changes its useful life. makes it longer, provides additional benefit. We record it as an addition to the asset account. We debit vehicle on the asset account when we replace something like a transmission because it's a major overhaul. It improves the asset. And it's, of course, on the balance sheet. So ordinary repairs, that's on your expenses, on your income statement. Real simple, maintains the operating condition, doesn't change any type of useful life. It's just repairs and maintenance. Yep. Regular stuff. Extraordinary repairs, these are things like replacing a transmission. It improves the overall asset and it extends its useful life. So we add that to the balance sheet account. That's the difference between the two. Here's an example. So a repair expense, simple repair, okay, normal stuff. Debit, repair expense, credit cash. Yeah, just a simple expense. This is an oil change, okay? This is something simple. Just to continue the operation of the equipment. And then we have improvements. This is the new transmission. We debit machinery and we credit cash. It increases the value of the machinery, you see, because we're improving the useful life of the machinery. That's the idea here. Now, what happens when it comes time to get rid of an asset, to dispose of it? Let me show you what that looks like. Now, when we get rid of it, it either happens at the end of its useful life or sometimes before, because maybe we don't need it anymore for whatever reason. Either way, we have to update the depreciation schedule based on the date of disposal. Now, we do this in really one of two ways. If we're selling it and we're just getting the scrap or whatever, we debit cash if we receive it, or if we're paying it, we credit it, as you know. And then we remove the accumulated depreciation with a debit. If we're selling it and we're gaining something from it, meaning I'm selling this asset before the end of its useful life, and I'm selling it above its book value, that's a gain. So we debit the cash, we credit the gain. If it's a loss, we debit it, and we remove the asset. I'm going to show you what this looks like a little simpler in this slide here. If the cash is greater than its book value, we record the gain. If it's less than its book value, it's a loss. If the cash is the same as the book value, there's no gain or loss. I'm going to show you what it looks like through some journal entries and examples. Our piece of machinery, as you know, cost $9,000. Here we are. We've reached the end of its useful life, and we're going to dispose of it. In this example, there is no salvage value. It's not worth anything at the end of its useful life in this case. So it's a real simple journal entry that we make at the very end of its useful life. We debit accumulated depreciation and we credit the asset, in this case, machinery. This recognizes the disposal of the asset at the end of its useful life. Uh, okay, here we have piece of machinery cost 8,000. The current accumulated depreciation is 6,000, and we discarded it on 7/1. So we record any remaining depreciation expense by debiting accumulated depreciation expense, credit accumulated depreciation. In this case, it's 6 months because we got rid of it on July 1. And then we debit accumulated depreciation, debit the loss of disposal of the equipment, and credit the equipment. Now, why is it a loss? You might be wondering. And it's because of the fact that we had a book value of 1,500 on the equipment, but the equipment isn't worth it. So that's why it's a loss. Sometimes we sell the asset at book value. So here we have an example. Piece of machinery originally cost 16,000, has accumulated depreciation of 12. We use straight line depreciation, 4,000 per year on this piece of machinery. We sold it for $3,000 in cash. Since we sold it on March 31, we debit depreciation expense 1,000. That's to recognize the 3 months that have passed. Credit accumulated depreciation for that equipment. When we sell it, we debit the cash 3,000, recognize the cash we received. Debit accumulated depreciation 13,000. And we credit equipment 16,000. There's neither a gain or a loss in this situation. We sold it at book value. Sometimes you might get lucky and sell it above book value, selling it for more than what it's worth. Same conditions. First, we recognize the remaining depreciation. Sold on March 31, debit depreciation expense, credit accumulated depreciation to recognize the 3 months of depreciation expense. Second part's obviously a little different here. We debit cash, in this case 7,000, that's how much we sold it for. We debit accumulated depreciation for the equipment, 13,000. Okay, so that recognizing its book value. We credit an account called gain on the disposal of equipment. The gain on the disposal of equipment is the account that we're crediting here. In this case, 4,000, and we credit the equipment, 16,000, to remove it from the books. What if we sell it below what it's worth? Okay, I never recommend that you do this. But let's say we sell it below what it's worth. Same thing. We have to debit depreciation expense, credit accumulated depreciation for the 3 months because we sold it on March 31. We debit cash, 2,500. That's the amount of cash we collected from the sale. We debit the account called loss on the disposal of equipment because we sold it below its book value. In this case, $500. How do we figure $500? Its book value at the time is $3,000 minus the $2,500 in cash that we sold it for. It's us a $500 loss. We debit accumulated depreciation 13,000, credit equipment 16,000. Okay, so that's what happens when we dispose of an asset. Another thing that companies sometimes have to account for, depending on the type of business that you're in, are natural resources. Natural resources, these are the things that come from the earth. They're naturally here. Oil, coal, gold, cobalt, whatever. There's a bunch of minerals out there. Okay. If your business is in mining or extracting natural resources from the earth, you need to account for the depletion of those resources. Depletion means that we're depleting, extracting, using what is there. Okay, we're depleting it. We're going to take all of it. All right? Depleting it. We're consuming it. We're using it. We're depleting it. Okay? Because natural resources like oil, coal, and gold, once you take it, it's gone. It's not renewable. Okay? It's not like oxygen. It doesn't renew. You see? Okay, so we have to recognize the cost of this. We look at the total cost charged to depreciation expense over the periods that it benefit the company, and it's based off the amount that we're extracting from the earth. That is cost minus depreciation. It is a two-step process, and it's very similar to the depreciation process. Depletion acts the same way. We take the cost minus the salvage value divided by the units of capacity. Units of capacity, these are the tons of materials being extracted from the earth. That helps us to find depletion per unit. We take the depletion per unit and multiply that by the number of units extracted during the accounting period. How many tons we took during that year. So in this example, we purchased a section of ore, natural ore for $500,000. Salvage value is going to be 0. We expect to extract 250,000 tons of ore from the earth. This gives us a depletion per unit expense of $2 per ton. We take that $2 per ton and multiply that by the number of tons we did extract during that first year. In this example, 85,000 tons. Our depletion expense for year 1 was $170,000. I want you to think of this as the same way that when we talked about units of depreciation. Works the same way. Yep. So this would be the journal entry we would make. Debit depletion expense, a credit, and we credit accumulated depletion. You see, works the same way. And of course, we also recognize anything that's unused. So you don't need to worry too much about this. I just want you to understand that the depletion expense works the same way that units of depreciation works. So extracting natural resources from the earth, of course, there's going to be machinery involved. But so we follow the same units of production method. Yeah, that's what I was trying to get to. And one of the last type of assets I want to talk about today is called intangible assets. Intangible assets, these are assets that you cannot physically touch. That's what the word intangible means. A copyright. You can't physically touch a copyright. Goodwill. I can't physically touch goodwill. A lease agreement. I can't physically touch that. A patent. I can't physically touch a patent. You see, a franchise or a license. Can't physically touch those things. We call those intangible. They don't have a physical substance used in operations, that is. For Intangible assets we record at cost when we purchase it. We have limited or indefinite use on these intangible assets, and they often provide exclusive rights. Patents, copyrights, franchises, trademarks, goodwill, a lease agreement, leasehold improvements, other intangibles, and research and development. These are all examples of intangibles, and they also represent the cost of determination and amortization. We record them at cost, including the purchase price plus legal fees plus filing fees, etc., just like we do with any other asset. Now, how do we determine useful life, you might be wondering, on something like this? It depends on what it is. For example, a patent typically is for 20 years. Copyright can be up to 70 years, and franchises depends on the term of the agreement for the franchise. Goodwill. This is a term that you may not have heard before. I mean, yes, there's a store called Goodwill, but that's a little different. Goodwill is the amount of which the company's value exceeds the value of the asset and liabilities that it's acquiring. This is very common when one company acquires another company and pays more than what that company is actually worth. We call that goodwill. Rights of use, this is a lease agreement. Leasehold improvements, that's when you improve the property that you're leasing. This is very common, like if you rent a storefront and you improve the storefront by putting in new flooring, walls, lighting, etc. We call that leasehold improvement. And of course, other intangibles might include things like software, customer lists, etc. Research and development is also big for a lot of companies. This is where we're doing research and development to develop new products, processes, or knowledge. Okay, so that's all I have for intangible assets. Now, before I let you go for the evening, one of the last things we need to talk about is, yes, at least one ratio. This one's called the total asset turnover ratio. Total asset turnover ratio, the idea here is that we're trying to figure out how efficient the company is at using their assets. Yeah? How well am I turning over my assets? We take net sales divided by average total assets. Now, in accounting, to find the average of something, we take the beginning balance plus the ending balance divided by 2. That gets you the average. Right. So that's the ratio. And then just real quickly for the appendix, one of the things I wanted to mention is you don't have to just pay cash when you purchase an asset. Sometimes you can exchange things, right? It's like, I want to purchase your Xbox Series X. So what I'll do is I'll trade you, exchange, a bicycle and something else. We call it exchanging. Yeah, rather than just paying cash, you can exchange. So that happens sometimes in business too, right? I'll give you this piece of land if you'll give me that piece of machinery or whatever, right? Exchange. So this is an example of an exchange. We got a company that acquired $42,000 in a new piece of equipment. They exchanged $33,000 in cash plus some, what else did they do? Some other equipment. Yeah. So this just kind of shows you what that exchange looks like. I wouldn't worry too much about it, but it works the same exact way for depreciation and gain and losses as the other stuff that I showed you earlier does. But that's how exchanges work. So don't worry too much about that part. Okay, we made it to the end of today's discussion on property, plant, and equipment and depreciation. Any comments, questions, concerns? You all good? Yeah, really? Okay, awesome. Great. Before I let you go, as a reminder, you have your hypothesis for this week. Some of you have already started it. Thank you so much. Please work on that. All right, let's try to get that done by Thursday. Yep. And then you have your quiz for this chapter. I will take care of the grading for your discussion board from last week. I'll take care of that tomorrow. Okay. In the meanwhile, if you have any comments, questions, or concerns, you can email me, call me, or set up office hours, whatever you need. I'm always here for you. You know that. And I want to, again, thank you all so very much for your time today. I sincerely appreciate all of you and your hard work that you're doing. Keep it up. Let's keep moving. We're almost there. Okay. Thank you all so much for your time today. Appreciate all of you. Have a wonderful rest of your night. Take care. Bye-bye.